Good morning, and welcome to today's webinar, Maximizing Your Dealership's Tax Benefits under the One Big Beautiful Bill Act. The most significant tax reform since 2017 just became law, and it includes provisions that could save your dealership substantial money if you act before year end. The One Big Beautiful Bill Act introduces several game-changing opportunities specifically beneficial to your dealership. We'll have time today for Q&A at the end of today's session, but if we don't answer your question, or if you'd like to take a deeper, more personalized dive into the information, please get in touch with us. Our presenter's contact info is in the bio section on your screen. To submit your questions, use the Q&A box in the lower left corner of your screen. Today's event will be recorded, and you will be emailed a copy of today's recording. Today's presenters are Nicholas Walters, Principal and National Director of Dealership Solutions, and Ben DiGirolamo, Principal and a member of the Tax Advisory Group. And now I will turn things over to Nick and Ben to get us started.
Wayne, thanks so much for giving us that great introduction, and thanks to everybody for joining us this morning for this presentation on the One Big Beautiful Bill Act. In particular, we want to focus on provisions that affect our dealership clients, and I'm sure that's why you've joined us today. Nick and I have become very popular since July 4th and the passing of this bill. About as popular as we've been since 2017 when the Tax Cuts and Jobs Act was initially passed. And then also maybe some of the COVID provisions in 2022 made us popular. But the reason for that, and likely the reason that you all joined us today, is you're asking the very reasonable question. When you see such a significant piece of tax legislation, you're asking the reasonable question of what does this mean for me, and what does this mean for my business? And certainly there's some significant implications of this bill that are affecting individuals and businesses, really affecting every area of tax, in addition to, also state, estate, and gift taxes as well, which we're going to touch on a little bit today. And so just a little bit of history on this. I mentioned the Tax Cuts and Jobs Act in 2017. That was a bill that was passed in President Trump's first term in his first year in the office. And it was seen as the most significant piece of tax legislation that we had seen since 1986. It was really more of a almost full rewrite of a number of sections and significant new provisions, more so than we had seen in just little changes here and there that have occurred between those periods. And so fast forwarding until 2025, as we sit here today, many of the provisions of the 2017 Tax Cuts and Jobs Act were scheduled to expire at the end of 2025. That was concerning for us as tax consultants, and certainly for all of you as well, who are in business and need to do planning for your taxes and understanding what your liabilities may be in the future. And any time we're dealing with any kind of uncertainty like that, it creates difficulty for business and planning when you know that your tax liability is a significant item on your cash flow. And so now we do have some certainty with the provisions of the One Big Beautiful Bill Act that, again, were passed on July 4th of 2025. I think it was July 3rd, actually. I'm getting this mixed up. But that allows us some certainty now on provisions that were scheduled to expire with 2025. And we also have some new things that we want to talk about as well. So I think the biggest thing to keep in mind with the One Big Beautiful Bill Act is it extends a lot of the things that we became familiar with that were part of the Tax Cuts and Jobs Act, and avoided the expiration of many provisions that would have resulted in significant increases in taxes for individuals, for businesses, and had significant impact on estate and gift tax as well. So with the passing of the new act, not only do we have certainty, but we have a lot of extensions of what are taxpayer and business-friendly tax provisions that we want to talk about today. I also, before I dive into the business provisions, that's what I'm going to handle right now. And then Nick is going to join us a little bit later to talk about some of the individual provisions. And, Nick's going to feel free to interject in any of the slides that I'm on, and I'm going to do the same for him. For all of you that are attending, as Wayne mentioned, we've got this Q&A box, so please feel free to ask anything you have for us today. We'd be happy to answer it or follow up if necessary with any one of you. So I'm going to start this off by jumping into some of the business provisions of the new act. And the first thing we want to talk about is the qualified business income deduction. The qualified business income deduction is a deduction that's actually taken on an individual tax return. So why am I including it in the business provisions? Well, it's a deduction that's taken against business income. And for many of the dealerships that we work with, and I'm sure lots of you that are on the call today that are taxed as S corporations or partnerships, we have many that are S corporations, some that are partnerships, including, you may have your real estate in a partnership. The qualified business income deduction is something that you're likely taking on your personal returns to lower the effective rate of tax on income from your dealership. So going back and giving a little bit of history on this was something that was brand new in 2017 with the Tax Cuts and Jobs Act. We hadn't really seen anything like it as far as a reduction in the rate of tax on business income versus non-business income. And what it is a 20% deduction on qualified business income taken on the personal return that effectively lowers the rate of tax on business income compared to other sources of income. What are other sources of income? Think about things that are taxed at the ordinary income tax rates like wages or interest, short-term capital gains, non-qualified dividends. Those are things that are taxed at the ordinary income tax rate. Compare that to the business rate where you now get a 20% deduction, and you effectively significantly lower the effective rate of tax on business income. So also giving a little bit of history on this and the importance of the QBI deduction, or sometimes referred to as the 199 Cap A deduction. With the Tax Cuts and Jobs Act, we saw a significant decrease in the rate of tax on C corporations. So the C corporation rate had been a graduated rate that capped out at 35%. This is before 2017. In 2017, the C corporation rate dropped all the way from 35% to 21%, a significant decrease. The ordinary income tax rate at that time, before the Tax Cuts and Jobs Act, was 39.6%. It dropped under the Tax Cuts and Jobs Act to 37%. And Nick will talk about that later, that we're going to continue to have a 37% rate of tax on individuals. Flow-through entities like S corporations and partnerships, which is how many of the dealerships that we work with are organized, are taxed at the owner level, and they're taxed at the individual tax rate. So just going back, the individual tax rate, highest rate, is 37%. The C corporation rate dropped all the way to 21%. And so a lot of people started asking the reasonable question, why would I want to be a flow-through entity? I've always been told that it made sense for me specifically, and it might not. There's lots of reasons to be a C Corp too, but it made sense for me to be a flow-through entity. But if a flow-through rate of tax is 37% and the C Corp rate's 21%, shouldn't I look at being a C corporation? Well, introduce the 199 QBI deduction. When we take a 20% deduction, phantom deduction against our income, we're effectively lowering the rate of tax on our income by 20%. And so when we do that, when we're only taxing 80% of our income, that effective rate of tax on flow-through income drops to not be 37%, but it drops to about 29.6%, or just under 30%. That's still higher than the 21% C corporation rate. So year over year, you might have a little bit higher of a tax rate from flow-through entities than you would as a C corporation. However, given a little lesson on C corporation tax, C corporations pay tax at the entity level. They pay a federal income tax at the entity level. And then owners would pay a second layer of tax if they strip out earnings in the form of dividends. The dividend rate at the highest rate on a federal level is 20% plus the net investment income tax, which can apply at 3.8%, making dividends potentially taxed at 23.8%. So if the C corporation makes money and pays tax at 21%, it only has 79 cents on the dollar after paying its federal income tax to distribute to its owners. If it distributes that 79%, and that 79% is taxed at 23.8%, the qualified dividend rate, we're now whittling away again with a second layer of tax on that income. And the effective rate of double taxation, the 21% at the C corporation, then the 23.8% of the owner on their dividends, brings us to almost 40% as an effective rate of tax on a C corporation. Okay, now jumping back, what did I say with the flow-through entities? Once I get the 20% deduction for QBI, I get to an effective rate of about 30%. So we have about a 10% delta between the taxation on flow-through income at about 30%, and C corporations, once we apply the double rate of tax, are taxed at about 40%. So what happened under the One Big Beautiful Bill Act? The QBI deduction, 20% deduction, was brand new back in 2017, but it was scheduled to go away after 2025 until the One Big Beautiful Bill Act, which has extended it permanently. And so if we had this, if we had an elimination of the 199A deduction, the 21% C corporation rate was not scheduled to go away. So if the 21% C corporation stayed in place and we lost the 199A deduction, now the question was going to come back again, do I still want to be taxed as a flow-through entity versus being a C corporation? The 199A deduction now being extended permanently kind of extends that benefit for the flow-through entities. We have lots of dealerships that are also situated as C corporations, and there could be other reasons for that as well, why it makes sense for them to be a C corporation. But we did have some that were considering making an election to be taxed as an S corporation and moving from C corporation tax to flow-through taxation. And when we didn't have certainty on whether or not the 199A deduction was going to continue to exist, that was part of that decision-making process. And at least for now, we now have permanency in the 199A deduction. And so flow-through owners will continue to pay an effective rate of tax of just under 30% on their income if they're eligible for this qualified business income deduction. Talking about some of the specifics, this 20% deduction, again, made permanent. What does permanent mean? I'll get this out of the way because there's some other things that were made permanent. Permanent means that they're not scheduled to change, that no passing of the clock or the calendar is going to make this go away. But it doesn't mean that it can't be changed with future legislation. So we could see future legislation that would affect this or any of the other permanent provisions of the act. But for now, this is the way the law is, and there's no scheduled expiration of these like we had under the Tax Cuts and Jobs Act. If you remember back, or if you were following some of the news on how this bill got passed, we first had proposed language from the House of Representatives that passed. Then it went to the Senate for their markup. They made some changes, and ultimately what the Senate changes are what was approved and signed into law. So you may have heard some things like what the House had proposed, which was to increase the 199A deduction to 23%. That would have reduced the effective rate of tax by about another percent for owners of flow-through entities. That was not passed. So for now, we still have the 20% QBI deduction, something that's not on the slides and less pertinent to dealerships, but still interesting, is that certain types of businesses, specified service trades or businesses like accountants, doctors, lawyers, are excluded from being able to use the QBI deduction once their income exceeds certain thresholds. Those income thresholds were increased. That is on the slide. Something that the House had proposed but did not make it into the final bill was to allow for at least some deduction for SSTBs, specified service trades or businesses, so they wouldn't be phased all the way out of taking the deduction, but would have been able to take about a 5% deduction. That wasn't part of the Senate bill. There's been some discussion about bringing some of those things back in future legislation, but for now, what we have is an extension of the 20% 199 QBI deduction. We also have an introduction of a new minimum deduction. This one was kind of funny to me. There's other phase outs and limitations to QBI, but it essentially says that if you're a material participant in the business, you would get at least a 400% deduction if you have, or excuse me, $400 deduction if you have $1,000 of income. Not sure why they thought this was so important to add. If you do the math, a $400 deduction at 37% is about $148 or $150. So, they spent probably some brain power and writing power to come up with something that probably doesn't mean a whole lot. And move on here. Talk about Section 179 expensing. And what changed under the One Big Beautiful Bill Act is we have an increase in the expensing limit of 179 property to $2.5 million annually, with a phase out for 179 property placed in service increasing to about $4 million. That's roughly doubling where we were under the current law. So this is being expanded for 2025. It was about half that under the prior law. And this is of particular importance to dealerships. The next couple slides, we're going to talk about bonus depreciation and the 163 business interest deduction. And there's some interplay here as well. But what 179 expensing allows taxpayers to do is to immediately recover the cost of eligible property that they place in service. Historically, that's meant newer used personal property that's used in the business. It's also been expanded to mean certain types of qualified real property. So there can even be improvements to buildings, to real property. And they expanded that definition to include replacement roofs, replacement HVAC units that may have otherwise been subject to a 39-year recovery period can be eligible for Section 179, which would allow for immediate expensing. And so the annual limit increased, as I say here, to $2.5 million, which is really helpful. And the phase-out amount has also increased to $4 million. So what does that mean? If I've placed in service more than $4 million of 179 eligible property within the year, I start to lose out dollar for dollar on my expensing limit. So if I placed in $10 million to go to an extreme of 179 property within the year, I wouldn't be eligible for 179 expensing. And so this is something that's seen as available to not the biggest of the biggest companies in the country, but certainly for a lot of the dealerships we work with, this is something that taxpayers are well within the limit each year for benefiting from. There's a lot of overlap with 179 and bonus depreciation, which is the next slide that I'm going to talk about. They both can apply to new and used property, and they both allow for immediate expensing of new and used property. However, over the last few years, we started to see a decline in bonus depreciation. And so our bonus depreciation had kind of become king when we had 100% bonus depreciation. We saw fewer and fewer taxpayers in general using 179. In 2023, the bonus depreciation limit dropped from 100% to 80%. In 24, it was 60%. In 25, it was scheduled to drop to 40%. So when we weren't getting 100% bonus depreciation, if we could take 179 at 100%, that was a better situation. With 100% bonus depreciation coming back, in general, 179 is less necessary. However, there's a significant exception that we need to talk about. We'll talk about in a couple slides with 163J and the interest limitation. A lot of dealerships may be excluded from using bonus depreciation because of some of the 163J rules that apply. And if that's the case, this is really important that we have an extension of 179. I should also point out that there's different state rules. So if you're in a state that has an income tax, which I'm sure a lot of you are, a lot of states decouple from the accelerated expensing provisions of bonus depreciation in 179, but they may have better rules for 179 versus bonus or vice versa. And so if we're getting the same federal treatment between Section 179 and bonus depreciation, sometimes it's a state consideration that makes us want to take one over the other. One example of that would be Pennsylvania, which just relaxed its rules on 179, so it follows the federal rule, but it doesn't have the same bonus provisions in Pennsylvania. So you may want to take 179 in Pennsylvania, but not on your, or you may want to take 179 over bonus on your PA return. And if it doesn't mean anything on the federal return, that's what you would do. Should also point out there's some additional limitations on 179 other than just the expensing limitation. You have to have income. You can only take 179 up to the amount of income that you have. And these $2.5 million limitations are applied at the owner level if we're talking about a flow-through entity. And so you can't take $2.5 million from each one of your dealerships if they're in separate tax entities. If you're flow-through, that limit would apply at the owner level as well. So next slide, bonus depreciation. I obviously started mentioning this on the last slide. We now have a permanent extension of the Section 168 bonus depreciation limits of 100%. As I mentioned before, we had 100% bonus depreciation for a long time. That started to phase out in 2023 at a 20% per year clip. So in 2023, the bonus depreciation limit was 80%. In 2024, it's dropped to 60%. It dropped to 60%. So some of you probably either filed your 24 returns or are filing your 24 returns now, and you have 60% bonus depreciation. For 2025, that was scheduled to drop to 40%. That's changed for property placed in service on or after January 19th of 2025. Why is it that date? That was inauguration date. So if it's placed in service on or after January 19th of 2025, we now have the option to take 100% bonus depreciation for those first 18 days. If you were unfortunate, if you wanted to take bonus depreciation, unfortunately, it's not going to be available at 100%. It would be the 40% limit. There's also an option for taxpayers on their first tax return ending after January 19, 2025. If you want to use 40% bonus depreciation, you can, and there may be reasons why you don't want to accelerate more depreciation, and so that's something we're looking at as well. Generally, this bonus depreciation is available for newer used property with class lives of 20 years or less. We see this within a lot of our dealership clients, not only with equipment and property or loaner vehicles that you're using within the business, but also we know that a lot of you own your businesses, own your real estate either in the operating business or oftentimes in a related entity. The general rules on capitalization of real property can be penalizing, right? We only get 39-year recovery of the building of the real property itself. If we can do a cost segregation study and pull out personal property that's associated with that real estate, then we can take bonus depreciation or maybe even 179 on some of those things, but oftentimes bonus depreciation. So this return of 100% bonus depreciation is incredibly important for not only the equipment that you might be using in your dealership, but for the real property where you can pull out things like furnitures and fixtures from the real property or qualified land improvements like the parking lots and the fencing and the landscaping, which is also a shorter life, that 15 years and eligible for bonus depreciation. Now being able to take 100% bonus depreciation could be a significant benefit for you if you're acquiring or improving your real property as well. And I do point out that this 163J floor plan exception still exists, which is also the next slide I want to talk about. So let's talk about this business interest limitation. This was something that was brand new as part of the Tax Cuts and Jobs Act. We hadn't really seen anything like it to apply across all business types. And what it said is that you're going to be limited on the amount of interest that you can deduct against taxable income in a year to 30% of your adjusted taxable income. And so, very common for all business types and industry types to finance their business and pay interest to a bank on their operations. And we had never had to consider whether or not that interest from money that was borrowed and used in the business would be deductible. Tax Cuts and Jobs Act changed that. And it changed it for any taxpayer that doesn't meet the definition of a small taxpayer or small business. A small business definition, as we sit today, 2025, is $30 million of average annual revenue. So if you're under $30 million of average annual revenue, and that applies across all of your related businesses, then you don't have to worry about 163J if you're under 30 million. If you're over 30 million, which I'm sure lots of you on the call are, and a lot of the dealerships that we work with are, then the business would be subject to this 163J limitation. And as they were going through the legislative process, and some of the information about this was started to come out, this was of particular concern for the dealership industry. Knowing that many of you finance your floor plans and are over this $30 million limit, this could create significant, we'd say, phantom income for your business on cash that's going out the door in the form of interest that you're paying on your for financing your floor plan that you're now not able to deduct against your taxable income. So fortunately, Congress came up with an exception to 163J. So this would be for taxpayers that are over 30 million, don't meet the qualifications being a small taxpayer. So you're subject to 163J. But you were over the limitation, meaning that you paid more than 30% of your adjusted taxable income in interest expense each year. You would lose some of that deduction. Well, the law came out and said for dealerships, floor plan interest will not be subject to this limitation. So there's no limit on deducting your floor plan interest, even if you are over the $30 million exception. The One Big Beautiful Bill Act, that's 163J, is still in place, but it made a couple of important changes. When 163J and this limitation first came into play, this adjusted taxable income calculation was really like a calculation of EBITDA. So it wasn't your taxable income. We got to add back depreciation and amortization, which could be significant in your business before applying that 30% limitation. That changed over time to be an EBIT calculation. So you lost the ability to add back depreciation and amortization. The One Big Beautiful Bill Act now brings that back. So now we're bringing back the EBITDA calculation. So you get to add back your depreciation and your amortization into the calculation of the 163J limitation starting with 2025. The Act also expanded the definition of floor plan interest to include dealers of trailers and campers. And so I think those initially weren't allowed. Your floor plan interest may have been subject to this 163J limitation. That's now goes away under the One Big Beautiful Bill Act. Something else to point out, as I mentioned in the last slide with bonus depreciation, there is one drawback. If you need to use this limitation, and this isn't elective, meaning that if your interest expense, including your floor plan interest, exceeds the 30% of the adjusted taxable income, that's no problem on the interest expense, except that they took away your ability to take bonus depreciation if you're needing to use that exception. That didn't change. And so going back and kind of bringing together these last three slides I talked about, thankfully we have the expansion of the 179 expensing because many of our dealerships are required or needing to use 179 to accelerate their expenses because they can't take bonus due to this 163J exception. The ability to add back depreciation and amortization to 163J, though, may allow you to not need the floor plan interest exception, meaning that you could take bonus depreciation. I've really just got one more slide that I wanted to talk about before. Nick, were you jumping on there?
Yeah, I was going to say, if you could go back real quick on that, I think one of the big things is the dealership may have more significant income, where some of those rental partnerships that are the self-rentals have kind of gotten trapped over the years with that 163J interest expense limitation. I have one that it's somewhere between $500,750,000 of suspended interest, which is cash out the door that we're not getting a deduction for. So now kind of having that EBITDA calculation will be huge to free up some of those suspended deductions that essentially has caused tax in the past. One other thing I think, Ben, considering here is individuals are planning kind of as we go into year end, a lot of this is going to get pretty circular between 179, the application of bonus depreciation, and where you fall out maybe with suspended interest expense, current interest expense. So I think one thing to keep in mind is that 179 and bonus are elective. You can elect to take on 179 one asset or all assets that are eligible. On bonus, it's all in that class life. So if it's 7-year property, you would have to take bonus depreciation on all the 7-year property. So I think one of the biggest considerations you have with the dealership is really looking at capital expenditures for the year, and how we then utilize those coming into the preparation of the tax return. Because you don't necessarily always want to create no income. You might want to take advantage of some of those lower tax brackets, having 10% or whatever that may be as a low effective rate. So I think the application of understanding the 179, the bonus, the 163J limitations are huge, but also planning for what your projected taxable income is to maybe accelerate some of those capital expenditures that were going to be in 26 now into 2025 to defer your tax to a later year.
Yeah, thanks for jumping in on that, Nick. Great point. And just an overall recommendation, in line with what Nick was saying. And what we're doing for most of our clients at this point is you likely have some idea or projection, or will be doing a projection soon for where your taxes would be with 2025. Now that we have some certainty on these rules, it allows us to either update a projection if you haven't done it yet, or really button down on what that's going to be for 2025, so you can help make some of those decisions. But also a great point on the related party rentals. We've seen that whipsaw a lot with 163J, and sometimes that happens in coordination with a cost seg study, which is creating significant depreciation deductions and beating up the taxable income. But it's also then preventing you from being able to deduct your interest expense. And so, yeah, you're right, Nick, that add back could be huge. All right. My last slide here on business before passing it over to Nick to talk about some of the individual provisions. Something else I'm sure you're very familiar with were the various vehicle credits that were eligible both for now new and used clean vehicles under the Inflation Reduction Act. That's all going away under the One Big Beautiful Bill Act. As you see there, many of these things are falling off at the end of September, both in the new and used clean vehicle credit and the commercial credit as well. There's been some discussion, and you've probably heard, on extending some of these provisions. But as we sit today, there's no extension of these credits, and they're going away after September. Nick, was there anything you wanted to add there before taking over?
No, obviously, the EV credits are a sales tactic from an auto dealer perspective. Those go away. I know I've seen a number of commercials recently of the manufacturers promoting that. Make sure you're in before that deadline. The interesting piece of this bill is the alternative fuel refueling credit, really the electric component of that. That's the EV chargers that are potentially eligible for a tax credit. That goes until June 30 of 2026. So kind of interesting that Congress decided to let that ride when, I don't know how EV sales are going. If you follow the market, follow Tesla, their sales have been down. So, I don't know where the trajectory of EV sales go, but intriguing that they left the provisions for EV chargers to be installed through June 30 of 26.
Thanks, Nick.
Yeah, thanks, Ben. I think specifically then, obviously, Ben touched on the 199A. That's really an individual attribute, but really affecting business income. Now kind of focusing specifically on the general provisions at a high level from an individual tax standpoint.
Sending you backwards. let me see if I can.
Are you able to get through? It's all right. There we go. Is Ben mentioned the One Big Beautiful Bill continued the Tax Cuts and Jobs Act max federal tax rate of 37%. Again, without the passing of this legislation, the max federal tax rate was slated to go to 39.6. Again, not a huge differential there, 2.6%, but when you're making a significant amount of taxable income, that does hit the bottom line. bigger provisions there is that does make that permanent. Again, to Ben's point, permanent for now until the next Congress decides they want to change the legislation. Also, there's always been talk about eliminating the capital gains, making that ordinary income components of that. None of that made it into this bill. This bill increased the capital gains tax brackets, make those permanent, then indexed for inflation annually. So favorable from a taxpayer standpoint on capital assets, and also from a sales side provision of a dealership. Standard deductions. So with the Tax Cuts and Jobs Act, a lot of taxpayers were taking an itemized deduction. There was a lower standard deduction, about half of where it kind of is currently kind of indexed. But what the Tax Cuts and Jobs Act did is implemented a state and local tax cap. So a lot more taxpayers were not eligible to itemize, thus taking a standard deduction. So we now have an elevated standard deduction. For 2025, it'll be $31,500. And what that does is it guarantees that each taxpayer on a joint return that is would be eligible to reduce their income by that amount. Whether they have itemized deductions less than that doesn't matter. $31,500 is going to come off taxable income. If you're able to itemize, meaning if you have itemized deductions greater than that $31,500, then you could itemize based on taxes, charity, mortgage interest, etc. I included here the no tax on overtime pay. I don't know that it will impact many of the individuals on this call because they would be non-qualified from an overtime perspective. But I suspect many of your employees will be directly impacted by this provision for overtime on hourly wages. So what the bill allowed for is a deduction on the individual income tax return of up to $25,000 on a joint, $12,500 for a single taxpayer. And what it does is it allows for a deduction of that overtime component of the pay. For 2025, the IRS has come out and said they're not changing any withholdings, so your W-4s will largely stay the same. So any additional federal tax that's paid in will just be refunded with the filing of that individual's tax return in 2026. What will happen here is your payroll providers will be reporting this as a separate box on the W-2. I think the key component here is that if you are paying your individuals, in the service department, any back office overtime, just making sure that that's coded appropriately in your payroll software so that they're able to take advantage of that tax benefit. And as Ben mentioned, a big provision here is this is available kind of retroactive. So this is available for 25, but it then does expire in the 2028 tax year. So you get a couple years of that benefit, and then that kind of goes away.
Nick, this is a spot where we've got a few questions. I think pretty good questions on this area, and as Nick mentioned, likely not available to the owners of the business, but you may have employees that you're paying overtime to. The rule's written that it follows the federal employment law, and so you can't just decide that somebody should get overtime to allow this benefit for them. It's really only available for those that are non-exempt employees, so those that are making under a certain salary threshold. And if they are, then you are required to pay them overtime under federal law. That's the overtime pay that's eligible for this exemption. And another question that's come through several times is what exactly is exempt or deductible from income? And it's strictly the overtime component or that additional pay. And so if somebody's working over 40 hours, it's not all of the pay on their 41st or 42nd hour of work. It's the additional pay. And so if their rate goes from $20 an hour to $30 an hour because it's overtime, it's not the $30 an hour that's exempt from income. It's the additional $10 an hour that would be potentially exempt.
That's a great point. I think you would think overtime, and that's over 40 hours, but it's just that incremental component of that. The alternative minimum tax from an individual standpoint, prior to the Tax Cuts and Jobs Act, you saw very frequently on high earners. After the passage of the Tax Cuts and Jobs Act, you really didn't see much in the way of AMT, which AMT is the IRS's kind of second crack at a taxpayer of paying tax to the IRS. With the Tax Cuts and Jobs Act, again, that was set to expire. However, with the One Big Beautiful Bill, that then continued that, made it permanent here starting in 2026. So really a continuation. I think a lot of the provisions that we're seeing are kind of a continuation, but also extremely favorable, because if they were set to expire, again, a lot of taxpayers would be paying more tax due to rates, but also paying more tax potentially due to the alternative minimum tax, kind of that flat rate that the IRS wants you to have paid in. Can you switch again, Ben? I'm getting the... Thank you. From a pass-through standpoint, so that would be S-Corps partnerships. Specifically, if you have a loss on the dealership tax return, obviously that flows through to the individual tax return, and that gets flowed through all the other sources of income in the tax return. Prior to the Tax Cuts and Jobs Act, you would have what's called a net operating loss, an NOL, if your business losses exceeded all your other sources of income. So that would be wages, interest, dividends, etc. However, with the Tax Cuts and Jobs Act, Congress didn't like businesses necessarily offsetting business losses with other sources, again, wages, interest, dividends, etc. So what they did back in 2017 is created an excess business loss. And what that said is at the time, I believe it was $500,000 will allow you to deduct to offset wages, interest, and dividends. So if you had $1 million loss in the dealership, and that largely could be created through using bonus depreciation. So if you're creating a significant loss in the dealership, you potentially maybe not able to use all that loss on your individual return. Unfortunately, with the One Big Beautiful Bill, that did make the excess business loss provision permanent. So that's one of those areas is Ben kind of talked to at the business side, is with bonus depreciation, you really have to kind of look at what the tax situation is, what the consequence of this is, because it does have implications at the individual level with suspended losses.
Nick, I would just add, because this question comes up, if you have income from one business and loss from another, by this limitation, you can always take your deduct income. So it's kind of like your net loss or income or loss amongst your businesses. That's limited by this against whether or not it can be taken against other types of income that are non-business income.
Yep, great point. Transfer taxes. So this slide specifically talks to each individual's lifetime gifting allowance. So currently, as we stand in the Tax Cuts and Jobs Act bill, you can transfer up to $13.99 million tax-free to any person. So you want to make a gift of $13 million, you can do it. That wouldn't incur a gift tax. Same with at the date of death. If you die with a $13 million estate, that goes to your beneficiaries. There is no estate tax. The one problem of this was with the Tax Cuts and Jobs Act, it was set to revert back to $5 million, then indexed for inflation. call it $6-7 million, which is somewhat problematic because under the current regime, we're at 13, almost $14 million. And that was really set to be cut in half. What the One Big Beautiful Bill did is it made permanent that each individual is allowed a $15 million lifetime exclusion. So what that means for a married couple is they could have a $30 million allowance of gifting and or for estate purposes. So extremely beneficial to families looking to transfer gift to future generations without incurring a tax liability. The consequence of this previous is, say you made a gift in 2024 of the 13.9 million. If that were to revert back to the 5 million, maybe call it 7 million with inflation, you really have no more gifting to do because you would already be at that 14 million threshold. So what kind of this does is it continues the Tax Cuts and Jobs Act allowance of additional gifting to future heirs or future individuals and at the estate level to future heirs of your inheritance. So I think one thing to consider here is under the gifting, now that we have such a permanent increased exemption, is the consideration of gifting part of the interest in an appreciating asset to a child. So if you're acquiring and I've seen this in several instances where you may not have your crystal ball of what you expect for your business into the future, but if you have intentions of potentially selling in the near term, you could always make a gift at a low valuation to the benefit of your kids through a trust, allowing that asset to appreciate that's out of your estate into the trust, into potentially their estate, but out of your estate, also letting that appreciation grow for the benefit of your children, but also not includable in your estate. So this is a very favorable provision, one that I don't think a lot of people think of. I think people think, generally speaking, of income taxes, but this is the IRS's final crack at a individual, at a taxpayer at death is the estate tax. So extremely favorable, I think, here. As kind of mentioned previous, if you're not taking the standard deduction, if you have the amount of deductions that would allow you to itemize, meaning itemized deductions are greater than the standard deduction, you're potentially then benefiting from the state and local tax deduction. And what the Tax Cuts and Jobs Act did is it put a flat cap on a married couple at $10,000 of state and local taxes deductible. So if you're in a state like Wyoming, it really doesn't matter because they don't have a state tax. But if you're in a state like New York, New Jersey, California, that have significantly higher state taxes, you really felt that income pickup because you weren't getting the benefit of that full state and local tax deduction. What is changing in 2025 is the state and local cap is increasing to $40,000. That said, they're not giving that to everybody. It is subject to a modified adjusted gross income limitation. You can see there in the second bullet point, $500,000 for 2025. So anytime your income exceeds $500,000, you're going to start to be reduced from that $40,000 maximum benefit. However, the floor is $10,000. So really a continuation of the Tax Cuts and Jobs Act, $10,000 minimum. However, it does allow for now individual taxpayers with income under or in that $500,000 threshold to potentially benefit from some of the additional state and local tax deductions. I think one of the pieces here that's extremely important, depending on the state that a taxpayer's in, is that during negotiations, Congress didn't like what's known as the pass-through entity tax or the PTET. And what that did is it was a state and local workaround that said at the entity level, so say at the S corporation level, the state of Indiana is going to impose the tax on the business income at the entity. So because it's imposed at the entity level, it's therefore deductible for federal income tax purposes at the business level. Then it passed that income, that credit through to the individual. The individual filed their return, had no tax due because it was paid at the entity level. Congress didn't really like that because they see that as a true workaround to the state and local deduction at the individual level. They really wanted to get rid of it. However, it did not make it to the final bill. So I think the big takeaway here is the pass-through entity tax is still a option, but you also have to look at that in tandem with what this state and local cap deduction is. If your dealership has $1 million, $2 million of income, you're really not going to benefit from the itemized state and local tax deduction benefit. You're going to be largely phased out. So if you're in a state that still allows or has a pass-through entity tax, you would want to consider that to at least deduct that tax versus the itemized deduction where you'd be limited to $10,000. So I think a huge benefit for anybody operating in a state that allows a pass-through entity tax election, because you're taking a deduction that has been, under the Tax Cuts and Jobs Act, a non-deductible tax, and now making it a deductible expense, reducing federal income tax. I think a good selling point for car dealers, at least that is auto dealers, is the car loan interest deduction. So what this does is for qualified passenger vehicles from the 2025, kind of retroactive now to 2025 through 2028, is allow the taxpayer to deduct the interest paid on that auto loan, capped at $10,000. Not sure, how many individuals will ultimately be impacted by this because it does have a modified adjusted gross income threshold is pretty low, $100,000 for a single taxpayer, $200,000 for married filing joint, but better than nothing. So you're paying the interest. You can potentially qualify for that deduction, and it's also one that it doesn't require you to itemize. So at least a benefit for taxpayers out there, whereas previously there was no deduction because this was viewed as personal interest expense. Charitable contributions, you see a lot where the dealership may pay a charitable contribution to an organization of maybe the dealer principal's choice, something that they're passionate about. Starting in 2026, there's a weird quirk to the itemized deduction rules. So what it says there and I'll touch on bullet point 1, what it says in bullet point 2 is that the IRS is going to put a 0.5% a floor on your charitable contributions. So what that says is if you had an adjusted gross income of $300,000, multiply that by the 0.5%, would be $1,500. So if you made a $2,000 contribution, your floor is $1,500. So you actually wrote the check for $2,000. Your floor is $1,500. So you're actually only getting the itemized deduction benefit of $500 there. So pretty problematic for individuals that are contributing significant amounts to charity because it is based on your adjusted gross income. That provision, again, is effective in 2026. So I think the key takeaway there is considering maybe accelerating some of those charitables into 2025 when we're under the Tax Cuts and Jobs Act regime of no 0.5% floor there. In addition, the first bullet point there, the One Big Beautiful Bill allowed non-itemized taxpayers to take a charitable contribution of $1,000 for single, $2,000 for married filing joint. So kind of favorable there. If you're not itemizing, you're at least allowed to get an additional $1,000, $2,000 deduction off your taxes to contribute to charity. I think this is one, the itemized deduction world is significantly going to change between the state and local increase, the charitable, kind of decrease having that floor. So you really kind of want to work with your advisor is what year, when does it make sense, maybe to do some of those significant charitable contributions. You typically see when a business sells, individuals are very charitable. Again, it helps the charity that they're passionate about, but it also is a tax benefit. Now you'll kind of really need to consider is that really what I want to do, considering that there is this floor in place with the 2026 and forward tax years. From an administrative provision, I think we'll all appreciate this reporting threshold. Starting in January of 2026, the IRS has increased the 1099 reporting threshold for NEC and miscellaneous to $2,000 from $600. So kind of increases that threshold to reduce the administrative burden of some of that 1099 reporting, which then moving forward in 2027 will be indexed for inflation. So that 2,000 won't stay fixed. That number will change as we go forward. I think the big takeaway here for me is kind of how you implement these strategies and year-end actions. A lot of it is if you don't plan now, it's kind of hard to buy some of those capital expenditures as you really hit October, November, December. If there's a contractor involved, getting them any lead time on any acquisitions of property. So I think the key here is, for auto dealers, consider, a final push for some of those EV credits. Those IRS portals, my guess, will shut down shortly here once the credit goes away. So any EVs on the lot, consider working to get those sold. At least you can potentially, if the individual's eligible, take the additional credit. And then also, too, I don't know how this is going to work moving forward with EV sales, but if there is any EV chargers that need to be installed, work with your advisor to determine if you're in an eligible area for installing those and what that tax credit would look like before June 30 of 2026. Another kind of action point is inventory planning, management. Again, with interest rates, floor plan. Interest is much more significant than we saw under the COVID timeframe with no inventory and low interest rates. So managing that inventory, in addition, managing to have kind of that right inventory, right? If EV sales aren't the way of the future, consider that depending on the market of where you're in. And I think the last bullet point there in the action items is that equipment purchasing. Like I said, if you don't do anything until December 31st, it really may be too late. Again, working with your tax advisor to determine, is 179 more advantageous bonus depreciation? Am I eligible for bonus depreciation? Working through some of those nuances with tax projections, I think is crucial. Decision framework, we have the first bullet point, the business structure, going back to Ben's kind of first slide, which was the 199A, that 20% pass-through deduction. A lot may be, and we're excited about the 21% corporate tax rate back in 2017. I think you have to be cognizant of what is your end goal, what is your strategy of your business, right? If the goal is to grow it, not pay dividends out and increase the size of the business, maybe it makes sense to consider that C corporation. But I think the bigger piece, specifically in the dealership space, is the consolidation of the industry, right? So if you're planning on selling, you would not want to sell, assets as a C corporation, then be subject to double taxation. So I think that entity structure is still crucial. I still see, significant benefits depending on the state you're in the state tax rate, the corporate tax rate, to being a C corporation, depending on the goals of the business. But it really comes down to the business objective and kind of your time frame on where you're at. Cash flow, tax planning, critical. The business is all about cash, right? Inventory, floor, and really then saving for tax. So don't let the tax tail wag the dog. Don't go buy those pieces of equipment just because, those loaner cars just because. Buy them because you need them, because there is a benefit to the business, but also then a corresponding tax benefit. I think, again, we touched on the state implications, the itemized deductions, the state and local tax, and pass-through entity tax considerations. I think more importantly here is coordinating this tax bill with your existing strategies, right? You don't want to just elect to be a C corporation today just because it's a lower tax rate. You have to look at what you're doing and what your goals and objectives are in tandem with those existing strategies. So again, dealership group within HBK, we service the auto, RV, heavy farm equipment, power sports, in formulating kind of these unique strategies. Each are so different in their own right. You may have a dealer that floors all their vehicles. You may have a dealer that has significant cash and doesn't floor any. So, it's hard to say, does 179 fit my dealership? Does bonus fit my dealership? How do all these intricacies of this tax legislation come together? I think the key there is working with a tax advisor, an advisor that's going to plan, not just fill forms, but really kind of plan for you, because to the prior slide, it's that cash flow planning, right? Nobody wants to pay tax. But if you can project, plan, and do it in an efficient manner, that really saves, and it allows you to plan where that cap spend is on cash. From this, I think, webinar, we're kind of at that hour. Just wanted to offer a complimentary limited scope one-on-one strategy to any of these provisions that we talked about to the dealerships. And in addition to that, we would obviously always welcome the opportunity to speak with any dealership individuals on the overall one big beautiful bill in a more in-depth. That would be more on a fee-based. But again, if there's a lot of these strategies that can be worked to deferring tax, saving tax, it would be hugely beneficial to the dealership from a cash perspective. So if anyone has any questions, feel free to reach out to myself, to Ben. We are obviously always happy to work with anyone to tax plan and save and implement these strategies. With that, thank you everyone for attending. If there's any questions, Wayne, we can take them. Other than that, I'll turn it over to you.
No questions currently, Nick, but thank you very much. And while I'm providing closing housekeeping now, folks, if you do have a question, feel free to submit it. Otherwise, I would just like to briefly say that's our show for today, folks. And thank you very much to Nick and Ben for all the helpful information. And thanks to everyone who attended today's event. Reminder that you will be receiving a copy of the recording of today's event. If you have questions for Nick and Ben, their contact info is available on Loft. There's no need to log out. Just end your On24 session and you're good to go. There is, of course, more information to come about the OBBB, so keep an eye out for that. And looks like we don't have any questions, so have a great day, everybody.